Good morning, folks. We're going to get started here in just a couple of minutes. We have a pretty good crowd already here. Want to thank you for making the time this morning for this Ask an Economist session with Chabin Concepts and me. My name is Rob Eiler. I'm an economist. I have a consulting practice called Economic Forensics and Analytics. I'm also a professor at Sonoma State University. And so what we want to do today is talk about what's going on in the macroeconomy and also talk about what's going on in California and kind of a look forward to what might happen, especially given all the convolution over the last 8, 9 weeks with respect to geopolitics and where we are heading toward midterms. But two real quick uh, logistics items. One is please use the chat function uh, to ask any questions you like. I will use that as a way of filtering anybody who does not want to ask a question. But at the end, we're going to have a little time for questions. And if you want to open the mic up and actually speak, we should be able to do that without a problem. Just raise your hand and I'll get to you when we're done. If you have any questions that are clarifying questions or something you've got to absolutely let me know, please don't hesitate to do that also. I'm going to keep my camera off for two reasons. One, on bandwidth, and the second one is because it might screw up the recording. We are recording this. And then thank you again. And I want to thank Chabin Concepts for being such a partner with me on these webinars over time. So, folks, let's get right into it. The way I've been starting these seminars with folks is to start with the American labor market. We are not going to have a second recession, or I shouldn't say second recession, but another recession in the United States without a real problem in the labor market. And the labor market is what we're going to call in a little while a low hire, low fire mode, which is a classic sort of late cycle, similar to the end of the 2010s cycle of growth. So this is the American labor market where that blue area represents in thousands the number of people who are working in the United States and in terms of have a job, but you can see very quickly these are from January 2019 to the end of March 2026, the severe cut during the recession, and then up the ladder we go toward the latest data from March. And you can see there's sort of this bumpiness on the far right-hand side. This is where we were right before the pandemic began. And we have seen still this sort of climbing effect. So we have not seen a trended change yet in the labor market, and we're waiting for that if we're actually going to have some change with respect to having a recession or not. Now, two things to think about. One, unemployment is creeping up. We're also worried about worker productivity. So when you get to this point in the labor market, you're also worried about the next person you hire and how productive they are. And that's why we're seeing income slowly starting to slow down. We're also seeing income slowing down in terms of gross domestic product growth because we still have this inflation pressure that seems foundationally within the American economy because demand continues to rise. So the weird trade-off, as we're going to talk about over the next couple of slides, is as the labor market continues to grow, it puts demand pressure in the American economy such that inflation does not necessarily want to descend. And if you don't have that descent on top of other policies you may be engaging in terms of macroeconomic policies, whether they be trade or geopolitical policies that push inflation up, you're getting this sort of second whammy around what's happening with respect to inflation. So we like this picture. What we don't like, it's the associated inflation picture, and it's very hard to detach them without a real supply side bump in our economy or a real strong technological change. And AI has not quite provided that yet. Job openings, as I talked about, that low hire, low fire, have actually faded. So we have low hire, but we also are seeing growth in terms of the net number of new jobs that we're bringing into the American economy. So this picture is a good picture. Juxtaposed to that are sort of related pictures. So the first one I wanted to show is the evolution of oil prices and gas prices at the national level. And if you live in California and you're on this webinar, there's a little bit of a detachment in the national data around what's actually happening with gas prices, even though everything kind of goes in step. The biggest problem is that oil prices themselves, in terms of daily barrel prices on the wholesale market, do not necessarily dictate the trended price at the pump. It will dictate some episodic aspects of it, but a lot of it's actually related to futures markets on oil. But the point is the following. This blue line is what we call West Texas Intermediate crude. This related line is Brent crude, or the European wholesale price for oil, and you can see the two are highly related. So they're on the left-hand axis in terms of the price of per barrel. On the right-hand axis is the national average price at the pump, and it just went over. These data are actually a little old. You can see it says April there. They're actually from the end of March because of the latest monthly data you can find. The daily data have us now creeping up on $4 a gallon. But the point is the following. You see that arrow there. Everything is moving up. So when you think about inflation relief, one of the things that the concern in the Strait of Hormuz and thinking about in generally in the Middle East has created is upward pressure on oil prices. It doesn't necessarily mean that the oil is not available, but the bets in the spot and the futures market for oil have changed the nature of how we're looking at oil markets and what ultimately is going to now transmit itself potentially through supply chains. So, what we're going to see in the next slide is somewhat related to this, and I wanted to tee up the next slide with this, is that we don't see much relief on the gas prices in sight, regardless of kind of what happens in the Middle East, because generally, when oil prices rise, they tend to tip the futures market upward with respect to oil prices, which then, in some ways, structurally moves gas prices up longer than the spot oil prices. So even if oil on the wholesale market falls quickly, gas at the pump will not necessarily follow. That's a classic economic issue in terms of if you want the gas prices to fall, stop buying it. Now, on the flip side of that, when you think about policy making around prices, the inflation that policymakers look at specifically at the Federal Reserve is this one, and it's called core personal consumption expenditures prices. Now, the trick here, and these actually are through February. I didn't change that header, and I apologize for that. These data are new as of yesterday. The February data on PCE, or what's called personal consumption expenditures, is 3%, which means that if you look at that solid blue line on this graph, the solid blue line is the 12-month look back is how much more it costs to buy stuff at home than it did 12 months ago. So in February 2026, it actually is 3% more expensive. Those red dots in this now shaded area here, that circled area is like, let's say, the last 24 months of data. And you can see it's kind of wobbling at this floor where we've achieved. But the red dots are where the current forecast expects that price to go through the end of 2028. You can see the blue line for a long period between January 2007 and where we are in February 2026 lived below that blue dotted line. The blue dotted line is where the Federal Reserve wants that blue solid line to kind of weave around on a long-term basis. But we saw that inflation spike, it fell down, and in that circled area, we've really struggled to break out in terms of moving it closer to that blue dotted line. The red dots still believe it or not, we still think that there's a good shot we will be able to get there by the end of 2028. The last little bit has confounded that. But here's my point in terms of tying the two slides together. What has happened in the Middle East is likely to change, let's say, sort of headline prices, or what you can think of as the price of goods and services that are very related to energy in terms of, let's think, gas at the pump. These data are called core because they strip out food and energy prices. And we want to say that there may be an episodic change in things like gas prices, but we don't want to start making policy changes based on something that might last, let's say, 6 or 9 weeks. The trick is with that blue solid line is that the longer that gas prices remain elevated, or more completely, the longer that spot oil prices and then future oil prices remain elevated, the more those changes begin to permeate supply chains. A great example are surtaxes you're starting to see with airlines, Amazon, UPS, FedEx, because the surge in gas prices is immediately imposing a cost on them, and they want to immediately move that through toward the consumer to share some of that risk. So since these data are just through February, we're watching very closely to see what happens next. We CPI, or what you can think of as the headline prices, were up in March, and that tells a story that we should expect this blue solid line to march up a little bit from the current level. But you can also see it's been curling up, and part of that's what's happened with tariffs. So we have a lot of different things moving the inflation rate up in terms of just pressure. And that leads to a real conundrum for the Federal Reserve because while labor markets are still providing jobs, the inflation issue suggests that we need to be thinking about either stable interest rates or perhaps even raising them after some drops over the last couple of years, recognizing that inflation had fallen and we wanted to relieve the credit markets of its own pricing pressures. We're now in this really weird pickle with the Federal Reserve that if things are happening in prices that are not necessarily driven by pure demand, we do not have an amazing way to address that through monetary policy. It really leads to a weird problem in terms of trying to provide some inflation relief because if interest rates go up, you might provide a little bit of relief, but if the problem is a supply side problem and not a demand side problem, the Federal Reserve really doesn't have a toolbox for that. On top of the fact that we already have this sort of baseline pressure to move prices up otherwise. So we don't want to lead to job loss through increasing interest rates, or at least the pressure on it, and not be able to relieve inflation as a natural benefit of making that choice. A real nasty puzzle to solve. And this is why it's very episodic in economic history. You see these kind of issues. Well, interest rate forecasts have actually started to show some change. So, one, these data are quarterly from 2022 forward. The latest quarterly forecast is just through the end of 2027. I'm going to show you the shaded area of the forecast window in just a second, but this is coming from Fannie Mae, or the government-sponsored organization that buys secondary mortgages from loan originators, thinking banks, credit unions, and sort of other loan originators in the mortgage market, if they conform to a certain set of criteria with respect to what that loan looks like. So that blue line is where they think the Federal Reserve is going toward the end of 2027. This is the 10-year Treasury yield, or what the government pays for long-term debt, and where it sees that market going. Why that's important is twofold. Notice that the blue line was above the black line. When that happens, you have what's called a yield curve inversion. When the black goes above the blue, you actually have pretty decent conditions in credit markets, sort of generally speaking. But the problem is the black line increasing means that you're not getting much relief in the 30-year mortgage market. So when you think about local housing markets and how they relate to credit markets, when that black line creeps up, it wants to push that red line up, because the natural opportunity cost of lending for mortgages is to buy government bonds in terms of having a very simple choice. So that's the forecast window, and you can kind of see that that black line lifting up is somewhat recent, but the point is a lot of it's because of expectations. And the other piece of it is also is whether or not equity markets are actually going to continue to provide returns specifically on what is forecasted as how AI is going to pay off. So one of the other real nasty conundra to solve recently is, how do all these forces mass up against the equity markets? And if we have an equity market problem, does that transmit itself to a state budget problem? So that's just one node. And the other one is, how dependent is the equity market on things like AI? And how does what's happening in the Middle East potentially look at or tell the market a story it doesn't like anymore, and it wants to start taking profits off the table? So that black line lifting up is an amalgam of all those pieces of information to try to figure out, well, how much more risk is there in the American economy, specifically when the government also intends to issue a lot of new debt to pay for its bills vis-a-vis the tax breaks we received with this so-called One Big Beautiful Bill Act. All that's starting to push interest rates up, not necessarily down. So this is this part two of the Federal Reserve's puzzle to solve. And we're not even talking about the student loan issue. In terms of the student loan situation is starting to mount a little bit in bond markets' minds. And we could have done the whole day really on what's been happening with delinquencies and how interest rates changing might change the way that bond markets are going to react to that. But the point is, just keep that one in mind looking forward in terms of how certain debt markets have maybe a little bit more risk when interest rates go up than other ones. So the macro forecast, the one I use comes out of the Philadelphia Federal Reserve, and every quarter the Philadelphia Federal Reserve interviews 40 forecasters and says, well, how do you see the American economy evolving? And I take three variables out of that. The first one is real GDP growth. And as of the end of the fourth quarter, 2025, or the end of the year, the data were looking pretty good in terms of being a little bit more optimistic than at the end of the third quarter of 2025. And that growth for this year looked a lot better. And generally speaking, we entered this year on a relatively strong note. Tariff policy had subsided in terms of being a relatively draconian, in terms of the big change that happened in 2025. We still had labor market growth, even slow but sure, but it was still showing at least warm signs, that low hire, low fire mode. And then we had what's happened in the Middle East. So this is as of March 2026. The next one comes out in May. And so we will see what happens in terms of maybe some transition to a less sanguine outlook. Now, high frequency forecasts that are kind of done on a weekly basis through multiple channels have all pushed the economy down about maybe somewhere between 0.5% or 1% for this year from where they were, let's say, 10 weeks ago. So we'll see how that ends up kind of transmitting itself. If you're a big sort of, macroeconomics fan, you may have seen that the International Monetary Fund put out its spring forecast and downgraded global growth as well as American economic growth, but only slightly, not as much as you might think. And that's because when you think about the economics of what's going on in the Middle East, we need to see a long-term problem remain to really have it start to transmit through those supply chains. Now, are we getting close to that? Absolutely. Will it be a major problem going forward? Only time will tell, and then we need to see some policy changes. The unemployment rate is driving some of that optimism in the sense that we don't expect a lot of change in the labor market. We kind of talked about that earlier. And those are same red dots we saw in the core PCE data. However, we have had an upgrade in the number, or an upgrade. We've actually had a downgrade in terms of the economy in these high frequency forecasts and an uptick in the percentage chance that we will see a recession this year. So watch for that as we get closer and closer to summer. If we don't see some geopolitical problems I'm sorry, recess a little bit or walk backward, we're going to have some problems in the macroeconomy, guaranteed. It's just a matter of what magnitude. It's not a matter of if, it's a matter of how much. So let's now talk about what's happening in California and locally. California's been a real funny experiment when you look at what's been happening since the pandemic and with respect to our labor markets. So we had the blue line is our labor force monthly on a seasonally adjusted base or seasonally adjusted on a monthly basis, going up toward the pandemic, the sharp cut, and then the evolution. We just recently had the same number of people looking for work, working for themselves or working for somebody else. The three together are the labor force in any economy, and just above the pre-pandemic line. The orange line is the chunk of that blue line that have a job for somebody or working for somebody else or themselves. That has still not gotten back above the pre-pandemic level in California. The number of people who are working for a California-based employer has fully recovered, meaning that when the recession hit, we actually have seen that jobs growth come back and go above it, which means we're in slight expansion mode. But over the last few months, that has flattened strongly. We have seen an uptick in Californians that are working, but like I said, we are not quite yet recovered. We're almost there. But the problem with this is a macrocosm of what's happening regionally, which we're now going to look at briefly through a few different lenses. So when you hear about the unemployment rate in your local area, that is a description of the people that live there, not the people that work there. So the first two slides are going to be what's happened over the last year, thinking the end of the calendar year. The latest data for January and February just came out on Friday, and they're still preliminary. So I want to show you what at least California EDD and Bureau of Labor Statistics say are their sort of final estimates. This is labor force growth across different areas of California. So if you are from, most of this is focused on Northern California, some of it a little bit central. And you can see moving left to right, Butte County, Shasta County, Humboldt County, thinking northwest California. We have the Bay Area kind of in the front here on the left-hand side, and then we have Sacramento on the far right, as well as LA and San Diego. So while most of the emphasis is on Northern California, I did want to put a little sprinkle of Southern California. Sacramento and San Diego's labor markets look pretty good in terms of having more people emerge and wanting to work. But Napa County is actually the one that's had the most change, and Butte County is right behind it. And that's also true in terms of the number of people that are living in those counties and working. Butte County and Napa County have kind of led the charge over the last year in terms of that growth. Now, you take that picture and look at that entire span. Almost every single one of these comparison counties or areas has seen growth last year. This is it looking from December 2019, right before the pandemic started. And you might say, well, that's so long ago now, and the pandemic should be a receding memory. And the answer is that's true in some ways. But if you look at some of these cases, for example, San Francisco and San Mateo counties blended, we're still not back. Sonoma, not back. Marin, not back. Humboldt, not back. Butte, not back. There are still counties that are under the shadow from a labor market standpoint, specifically in the number of residents working. They have not recovered. So what's been really nasty about what happened during the pandemic is the demographic change and the economic change still linger within some of these counties in California, which is somewhat dragging down. You can see on the far left-hand side, California has barely grown, exactly the things we talked about earlier. It's just barely eked out a little bit of growth on the employment side since the pandemic. That just happened in the last few months. Sacramento's had a real robust growth. And Shasta, if you're from sort of the North Valley here in California, Shasta's really been the standout, but Shasta has started to slow down a little bit too. You can see that there. Now, if we look at local employment, these are the changes in hiring over the last year. So it's a little bit more of a mixed bag. While we've seen more people that are that are looking for work in these local areas and actually are working as local residents, they're not necessarily working for local employers. That's much more of a mixed bag in terms of local hiring in these areas. And that's last year. You can see Alameda is it's kind of a strong case there, and also in Solano County, we've seen some slower growth there if you're in the Bay Area or around Sacramento area. And then you can see in Shasta and Humboldt, there's been some slowdown also. Then we just look at the longer view. This kind of underscores that same shadow problem. So we're watching very closely to see how these counties and really kind of California overall evolves over the next few years with respect to the change in the amount of hiring and what that means for different areas. You can see Shasta again has stood out in this way, but Sacramento has really seen some growth since the pandemic. So there are some areas of growth and some real bright lights in California. And California overall has grown just under 3% in terms of the number of people working. And we saw those changes in terms of the black line in that first graph of California. We need to see more. Now, if we look forward, this is a forecast of the sort of aggregate growth in these areas. I front loaded this one with sort of the northern part and the northwestern part of California, but you can see across this sort of northern California counties here and just sort of some selected counties that have relatively large labor markets. Growth across the board except for San Benito County, and that's a small place that's connected to San Jose and Santa Clara County. But I wanted to show that as a way of thinking that some rural counties are still have some pressure on them, but most of the northern rural counties look like they're going to continue to grow. Some of that's because they haven't quite recovered yet. But I also wanted to suggest that in forecasts, and forecasts are generally coming from EDD or some private sector forecasts like Lightcast. Uh, Construction and healthcare are kind of going in opposite directions. So healthcare is this drumbeat based on demography that's continuing to grow. For construction, we're seeing some flattening as well as in manufacturing and agriculture. So on the more goods producing side, there's more trouble. On the healthcare side, there's going to be this steady drumbeat of demand. So when you look at these data, some are between maybe 30 or 40% of the growth in most of these counties is either directly or indirectly related to healthcare. The rest of it's a blend of retail, personal services, some professional services, but not a lot happening with manufacturing, construction, and agriculture over the next few years toward the end of the decade. And a lot of that's because we had this surge coming out of the pandemic, and that slowdown continues. Now, on the other side of that, since we don't expect a real shock to our labor market, we don't expect a lot of change in interest rates, nor do we expect a lot of new construction. The home price forecasts are relatively slow and low, and most of these county forecasts toward the mid or toward the end of the first quarter 2027 from March looking forward are really kind of within the bandwidth of a margin of error. So plus or minus 2.5% is more or less a margin of error in these forecasts. So it's really flat, more or less. All the other counties in California, if you don't see your favorite county here, are between Riverside and Shasta on this graph. I put San Bernardino in the middle just to kind of give you a sense of what's happening there. But bottom line is, as you can see, Mendocino County, Trinity County, Humboldt County, Lake County, Sierra County, Butte County, Solano, all at the other end. We are starting to see kind of a reduction in the demand in our sort of northern rural areas of California. And some of that's cannabis related, specifically in Humboldt Lake and Mendocino and Trinity, but not all. So watch very closely what happens in those areas in terms of housing markets. But generally speaking, the California housing market is pretty much flat right now and not expecting a lot of change. A lot of that's because we don't expect a large amount of change in labor markets, sort of just slow and steady movement, not super, not a lot of growth, but not a lot of retraction either. Finally, I want to look at what's happening with K through 12 demand. This is something that's a demographic change. Here's California's outlook if we take the academic year 24-25 and look forward. Data came out in October, and I like showing these data because it reminds us of how demographic change ultimately changes labor markets, not now, but in the longer term. We do not necessarily want to see these lines moving down in earnest. This is the California forecast by the middle of the next decade, about 10% down the number of K through 12 in public schools. This is Butte County following the state almost perfectly. Shasta County doing a little better than that. The movement of demography towards Shasta County has led to more working families, which is giving some relief in the short term, still slipping a little bit in the medium term. This is Los Angeles. This is one of the major drags on California's forecast. San Diego's a little bit better than the state. Fresno's a little bit better than the state, but all of these noticed are all descending. Then we have Sacramento. Humboldt, Riverside, and the Bay Area kind of as a blend. But notice that Sacramento is up there. That's because, again, we've seen jobs growth, demographic movement towards Sacramento, and that continuation of working families moving toward the Sacramento metro area is providing relief in terms of where public schools are going. This is at least through the next 10 academic years. But all those moving down tell a story about an aging population, and all that puts weight on the local industrial mix and also on the local labor force that's available. So when those commodities prices rise and they start to move through supply chains, that's where you start to see a regressive tax on our small to middle income households. So that's something to watch for in terms of how policy issues are trying to provide tax relief. There's a lot of consternation in Congress that tax relief has not been large enough, or let's say, been focused more on our lower income households. We have debt markets that are not necessarily providing a large amount of relief. We're watching for that in terms of whether or not we see a real break, and if that begins to then cloud forecast looking forward. We talked about that low, higher, low, fire. We're basically at where we were right around the time of the pandemic. We're a little worse in terms of where credit markets are, but the labor market's kind of at that space in a late cycle mode. We will see how much longer we can hold on. And then finally for California, and really maybe more completely for the rural counties in California, we've seen a real mixed bag of jobs growth. Housing markets are starting to slip, and some of that is because the lack of job opportunities are starting to have people migrate out of those areas, which means you need to watch how the age changes are happening more quickly in our rural areas, specifically in northern rural California. Workforce development and what's happening with AI is going to continue. I have a question in the chat about AI, which I'll get to in just a second. But there are opportunities where local assets in water and power allow for more entrepreneurship, especially in rural California. That's where we're hoping that economic development, when I talk us, I mean, where Chabin and EFA work together on these things in cities and counties, that's where we think things need to happen. It's very attractive to bring data centers toward places because they immediately sort of fill in industrial space or warehousing that may not be utilized. But watch for that. That is not going to be a major jobs change. But water and power will be sought after by a lot of companies that are looking for those assets, especially in places that have long-term possibilities on those lines. And then think about how opportunity zones and placemaking can take place. Can you use the opportunity zones locally to then think about reshaping, especially your rural area, into a place where people want to move, families want to move, and where entrepreneurs can flourish? Those are things to watch for in terms of economic development over the next few years. Because other than that, it's going to be a real slow, steady, but marginally positive slog toward the end of the decade, given the current conditions and somewhat of the policy uncertainty we've seen in both Washington and Sacramento. So, folks, with that, that's kind of the state of the economy for right now. I did have a question in the chat on addressing the role of AI. AI, you should think of, has two major nodes looking forward. One is, will equity markets still want to invest in AI in terms of providing inbound capital? There's some threats around what we call private credit markets and being overexposed to risk in AI. That's kind of part one in terms of the finance side. The other side is the evolution of jobs loss or job replacement has had a really mixed bag, and it's been very intriguing to watch the data come out. A lot of CEOs have now come out and said that they have not thought about AI as a pure replacement. But at the same time, it seems hard to believe that that's going to be true long term. So watch for that sort of debate to continue. But the labor data have showed that we have not seen mass displacement of labor, nor is it necessarily a threat to happen in the next few years from artificial intelligence. And so much of that depends on how AI evolves and the real returns to it by replacing workers. So the next question I see is, seeing the K through 12 decline in the next 10 years in California, what's it mean for the future of housing? State policy being very aggressive to produce more housing units. Will there be more vacant units? And the answer is there will be more vacant units in the sense that there will be some building that you may not necessarily see a lot of demand for in certain places, specifically rural California. So rural California is going to be very cautious about how much more housing is built. But the trick will be that at the end of the day, especially if interest rates provide some relief, you will see you will see housing occupied, but it may be by fewer people than you expected. So one of the real tricky aspects of housing and sort of changing the affordability equation is that as you build, how many restrictions can you put on that building, that new building, in such a way that you can actually start to shape it to change your demography? Or are you going to have a lot of single people households that are aging people because they had wealth to afford the housing, but have an income that qualifies them for more affordable housing? And when they come in, they are there to stay. And you won't have that housing unit for a working family, and thus that person comes in as not necessarily a participant in the labor force, and you still struggle to find workers for local businesses. That's where that aggression needs to be shaped with economic and workforce development. Need to be very cautious about building too many houses in California. We got a question here about how long will the steady drumbeat of healthcare demand last? It'll last basically as far as the eye can see, probably at least one more generation. The current demographic forecast is we're actually likely to see more aging toward the 2030s and 40s and not necessarily a turn the other way. The only places that might be different than that are places like Solano County if we get a new municipality there. But for California, we're going to see more wealth moving here, which means more age. And that generally is going to mean more healthcare demand. Like I said, probably for at least one more generation, as hyperbolic as that might sound on the surface. Have I seen any promising workforce development initiatives around AI? And the answer is yes, I have, in the sense that there has been this sort of new world around trying to use AI in two different ways where humans have to reckon with it. One is in ethics, in terms of having the use of AI really go through a filter of whether or not it's the right thing to do when you're using AI in a certain way. So, for example, if you're looking to provide mortgages and you're using AI to seek out or seek out borrowers, does that put the borrower at risk? So some of that is actually you have a human being walking alongside of that to making sure that the borrower is not getting into something that they can't really afford, where AI can fine tune that engine. But talking to somebody about the nuances of that person is sort of complementing the AI. So some of that is there. And that's something I think is really good in terms of always remembering that we want to not lose the social or ethical aspect of what's happening with technological change. The second is that it's actually leading people to really think twice about how productive they can be. So, and this is kind of the promise of AI on the front end, is that humans would be more productive on the front end, and that they would utilize the AI in such a way to actually generate more goods and services. That seems to have actually taken hold more than, let's say, the displacement of workers. So, as long as that continues, uh, but again, I can't say with any more strongly that economic history has told us a story about technology that those that own the technology want to maximize the profit from the technology, and really doing that means this weird frictional space where you've kind of had as much AI employed as possible without losing your market. So that's still coming. We are not even close to that yet. I did have a question in the QA about specifically Northern California. How long will the steady drumbeat? Oh, okay. We had that, Rebecca. I think I answered that, but you wanted to know more about Northern California, let's say North rural California, North Valley. Expect it to be worse there because the aging problem is slightly worse in the counties that sort of live north of Yuba and below the Oregon border. The Kathy had about gas prices stay high over time. Do folks who commute look for more local positions? On the margin, yeah, but probably not in mass. It'd probably be more like you would do more days at home than if possible, especially if your employer is flexible around that. It'd be unlikely that people would start now suddenly looking for more local positions, especially if the local positions aren't there. So I don't expect a mass change there. Um, in terms of how gas prices staying high will reorient people toward local positions. Unfortunately, especially if you feel like there's people living where you're looking for workers that have workout or that are working in some other labor market in terms of maybe working in Sacramento and living in Tehama. Uh, the another question is that there's a workforce board of 11 far northern California counties. They're interested in an AI expert coming to the board. Sure. I can, Wendy, you and I, let's talk offline about that. Thank you. Um, just email me. No worries. You can email me at that email that's right there on the screen. There's been a mass layoff of, or there have been mass layoffs of software engineers and coders, et cetera. Is there a data source for us to see real-time layoffs? And the answer is no. Unfortunately, there's not one that you can really look at in real time, short of when there's a mass layoff, there's a notice that's pushed out through the federal government. But some of that could be juxtaposed to hiring some other way where the industry will basically balance itself out within 12 months. So there isn't what I would consider to be really strong real-time data, even if you're monitoring those mass layoff notices. It doesn't mean that those folks won't be sucked up again very, very soon. And thus, in terms of real time, labor markets are good to wait a month or two to make sure that the survey data you're using, the mass layoff data you might be looking at, the way in which initial claims and continued claims for unemployment all blend together. You're not making kind of you're not drawing the wrong conclusion from the data. And then we have two more to go. How will stock markets impact local economies? S&P 500 an all-time high, similar to the time of the dot-com bust. That's a great question. It's one I've had a lot of around. Right now, our current cycle is kind of being driven by two items. One is a lot of uncertainty and a lot of bets by institutional money that you will follow the movements up and down. So we're getting a lot of volatility, primarily because there's so much uncertainty in the economy. But the upward trend is being driven primarily by what is expected to be the returns from artificial intelligence in the major companies. Think Meta, Amazon, Microsoft, Google, Apple, etc., where there's a large technological stake in AI and how that can lead to profits for those businesses. A lot of it will boil down to how much more the market believes we're going to see returns on AI assets and how large those are going to be. At some point, you generally have profits come off the table. The trick is if how overinflated, and this is kind of the point of your question, or you can think of it as a speculative bubble that exists inside of that market in such a way that if any company starts to look like that they are overinflated in terms of value, is that going to pull the rug out from the entire market? That's really where the trickery lies in the end, is can we tease out how much of it is not real? And this is a classic conundrum in equity markets to really say this is fundamentally what should be happening, and this is the over demand. And what we've seen volatility wise the last few weeks suggests that the market's still trying to figure it out, specifically with what's happened in the Middle East and how to correct what might be happening in the macroeconomy over the next, let's say, 6 months. And are there any slightly delayed data to see macro trends? And the answer is yes, there are. The main ones I tend to look for are ones that are around delinquencies, which are delayed about a quarter or two, because that really tells you where there might be more market stress in terms of lending markets. And if we look at the last few recessions, generally speaking, they are more around financial markets than anything else, excluding the pandemic recession, because that was really a social decision to turn off the economy for a lot of the right reasons, but that's really what created the economic downturn there. The recession in the early 1990s, in the dot-com era, and then the global financial crisis all had their underpinnings in financial markets. So one thing to watch for is just what's happening. And one financial piece of data I look for is what's happening with loan delinquencies, because that can start to tell a tale of how, let's say, fringe lenders are overexposed to risk. And if that risk comes to bear on them, how many sort of concentric circles does that affect in lending markets who use sort of what you could think of as the classic sort of stalwart lenders and financial houses as funding sources? And if they start to lose on the front end, does that ripple back and start creating losses in these larger companies? That means they're going to start reducing credit availability, and that's going to slow down the economy. So that's one of the pieces of data I look at as really trying to ferret out what's happening in lending markets. So check that out. Folks, thank you so much for your time today. I appreciate it, and thanks for sticking around a little later than 9 o'clock. This recording will be available at Chabin Concepts soon. And again, I want to thank Chabin as a partner on this, and I hope this was educational today. Please email me if you have any questions you can think of after this. Have a great week. Take care.